Hi, this is Ben, and this is your Belmont Math and Science Center tutor tip. We're going to go over the accounting process of how to do inventory valuation. In this video, we're going to be looking at the first in, first out method, which is FIFO. We'll look at the LIFO and weighted average method in other videos. So we're going to take a look at this example using the perpetual inventory system, which is just saying that we are going to update our inventory and our cost of goods sold after each sale or purchase. And so the first thing that we're going to do with this problem is we're going to look at January 1, our beginning inventory. We're going to add that to our ending balance. So our ending balance is basically going to be our total inventory cost column. So the first thing we're going to do is we have 125 units. Each of those units cost $10. So our total inventory cost is $1,250. So we have $1,250 worth of inventory at the beginning of the year. So the next thing we're going to do is we're going to purchase some more inventory. We're going to buy 100 more units at $12. So this will give us a cost of $1,200. And so again, our ending balance is going to be a reflection of all the inventory we have. So we're going to bring down our beginning inventory. And then we are going to add our purchase. And then we are going to give a total. So we're going to add from our beginning inventory cost, which is the $1,250. And we're going to add that to our purchases, which is $1,200, and that will give us $2,450. So that is the amount of inventory that we have at the moment in terms of a dollar amount. So we're going to do a sale on March 17th, and we're going to put this under the cost of goods sold because we're trying to figure out how much it costs us to sell these units. So we're doing first in and first out, and this is the critical part. We're going to look at what we bought first, and then we're going to work backwards if we need to. So we had 150 units that we need to sell. So our first thing that we brought in was 125 units in our beginning inventory. So we're going to put 125 there, and those cost $10. So we have the total amount right there. And then we still need 25 more units to get to our 150 sold. So we're going to take 25 units from our purchase that cost us $12 per unit. We're going to multiply those two together, and that's $300. And to get our total cost of goods sold for this transaction, we'll add those two together, and we get $1,550. So next we need to update what our ending balance is in our inventory. So we just took 125 units from our beginning inventory right there. So we can go 125 minus the 125. That obviously gives us 0. It was still $10. And when we multiply 0 times 10, we will obviously get 0. So next we have to look at our purchase amount of 100. So we use 25. So we do that 100 minus the 25, which will give us 75. It cost $12. And we will multiply those two together. And this is our total ending inventory. So we have 900. We have our 0. Our 0 plus our 900, and that is our total inventory amount at the moment after our sale. So we're going to buy some more units. We have on July 5th, we are buying 75 more units at $14 each. When we multiply those two together, we get $1,050. So again, we're going to update our inventory. We have our 0 at $10. We have our 75 units at 12. And now we have 75 units at 14. And this is going to give us our total amount. We're going to do our 900 plus our 1,050, and we now have $1,950 worth of inventory. So we're going to go and do our final sale, which was on October 13th. I'm going to go to cost of goods sold. We're selling 100. All right, so first in, first out. We don't have any in our beginning inventory amount anymore, so we can't do that. We do have 75 left, though, in our first purchase, so we're going to put 75 units there at $12. And we still need 25 more, so we're going to do 25 at 14. There we go, and we will multiply those together to get our cost, and then we will add the totals up, and that will be our cost of goods sold for that particular transaction. We'll update, so we're still at 0 for our inventory from our beginning inventory. There we go, and then we will be doing 75 minus our 75 at 12, and then we will do 75 minus 25 at 14. So again, this will give us our total inventory amount of $700 after that sale. So by using our first in, first out method, we figured out that our total ending inventory for the month, so we'll write that out here, our total ending inventory for the year is $700. Now we have to look at what our cost of goods sold, our total cost of goods sold. So how we can figure that out is we can add our two totals from our two sales. So our total from the first sale was 1,550, and our second one was 1,250. So that means that our cost of all the sales we did in the year in both sales was 2,800, and we now have $700 of inventory remaining at the end of the year. So when we were putting that in our balance sheet, for example, we would put $700, and this is just the method. FIFO is the method in which we determine how much our inventory actually costs and how much we should value it. So I hope this tip helps. We'll be back to do LIFO and weighted average next.